Hey guys, what's up? Jacob here. I want to do a quick tutorial to show you how you can get on Yahoo Finance and pull down historical data for a given stock to estimate future expected returns by using a market proxy, which in this case we're going to use the S&P 500. So whether you're a serious investor, a hobbyist, or you simply are interested in basic financial concepts, this might be useful information to you. All of this information is available, it's public, and it's right at your fingertips. So it's cool to know how to do this kind of stuff. Hope you like this. So anyways, we're gonna get started right up here in the search window. We're gonna drop in the ticker symbol of the stock, which today we're gonna look at Nvidia. So Nvidia is a high growth, large cap stock, tech stock. This company builds graphics processors, and so they're doing a lot in AI, a lot in technology, emerging tech. They're going to map with the volatility, price movement of most of your big tech companies. What we're after today is historical data. So we're going to click here on historical data. We're going to expand this time range to 5 years from the last posted month, which takes us to 2017. And then we want monthly prices. So if you look, this gives us our data set. We're going to click download. So drop a CSV into downloads, and then we're going to open that CSV in Excel. All right, so as you can see, our date range here, August 17 through July of 22. We have our open, high, low, close, and then adjusted close. This is what we're after, the adjusted close price. So the adjusted close is going to price in information, corporate decisions like dividends, stock splits. It's a more consistent figure when trying to determine historical returns. So we're going to copy that, and then I built a spreadsheet here that I'll kind of walk us through. So we're comparing Nvidia with the S&P 500. The ticker for S&P 500 is HAT-GSPC. So if you're confused by that, that's just what that means. We're measuring the adjusted close and then the natural log of the return, which is a continuously compounded return of Nvidia against GSPC or S&P 500. Two more things to note. One, up here we have the risk-free rate. So the risk-free rate is a rate that, technically there's not a risk-free investment, but this is a theoretical rate given to, it's a rate given to a theoretically risk-free investment, which typically in the industry, long-term treasuries are used. These notes are underwritten by the U.S. government, and chance of default's pretty low. But there is no truly risk-free rate. But for the sake of our deal today, I pulled the 10-year treasury rate, which is 277. And then here we have, this is what's known as the market risk premium. So it's the difference in the return on the market, which again, we're using a proxy of the market, S&P 500, the difference between that and the risk-free rate. And so this becomes meaningful as we calculate expected return. Okay, so let's get started. We're going to copy the adjusted close pricing in here. And then we're going to take the natural log of the return, which in this case, between August and September of 17, we saw positive growth of 5.45%. And then if you just double click this little box, it'll auto-populate the information down. Super helpful. So as you can see, volatility or fluctuation in price in return is quite a bit bigger than this index here. But as we'll see, that's explained by some of the figures we're going to look at down here. So let me explain really quick what we're after. We are taking the standard deviation, or the sigma, of this index. It's a measure of risk, a measure of price volatility. This is the standard deviation of this range of data. and then we annualize it by multiplying it against the square root of 12. We want to see what the correlation of the market is. In this case, this is our market proxy. So we have a perfect correlation. We just use the correlation function, measuring the returns against themselves. And then same with beta. Beta is a measure of market risk or systemic risk. In this case, because we're looking at, again, a proxy to the market, we have a 1 for the beta. Basically what this means, you'll see betas higher or lower. It just means that for every percentage increase or decrease in the market, a stock with a beta of, let's say, 1.2 is going to see a 1.2% increase for every 1% increase in the market. It just gives an idea of that stock's sensitivity to market risk, which is risk that can't be completely mitigated. And then of course we have the expected return. So if you look at the 30-year historic return of the S&P 500, it's somewhere around 10%. So we're just factoring 5 years, and I've got this market risk premium here is a contributor to this price, or to this percentage, because we're actually using this. This is a capital asset pricing model, which we're using to derive this expected return. If we were to look, I have this because we're looking at the S&P 500 over a long period of time. The last 10 years have been extremely volatile. So if we just mapped in the market risk premium over the last 10 years, this might be as high as 12.5%, 13%. But I think this is a little more in line with historical pricing, and using S&P 500 as a benchmark, it just gives us maybe a little more solid of a backstop. Okay, so let's factor in now the numbers on our Nvidia stock. So again, we're going to take the standard deviation as a measure of risk here of the returns over our selected time frame, which is not showing up for some reason. Let's try that again. Let's take dev. That's weird. Had that in as, I guess, white text. Okay, so there we go, 13.65%. We're going to multiply this times the square root of 12. This just annualizes this figure. And correlation of the market. So we're going to look at how this stock correlates to our market proxy. Essentially, that just means, if the S&P 500 goes up, does Nvidia go up? If so, it's going to be positively correlated. Let's say the S&P 500 went up and Nvidia went down. In that case, that would be negatively correlated. So we're going to use the correlation function here. Our first data array is Nvidia's returns, and then the second array is the market returns. Again, we have this weird problem where these numbers are coming in as white. There we go. So now the beta. So Yahoo Finance calculates the beta for Nvidia at, let's look at this, 1.64. And that's the 5-year monthly beta, which is what we're after. So our number should be pretty close. So the formula for beta is we take the correlation multiplied by the annualized standard deviation of our stock divided by the market, and we get 1.696. So we're pretty close. I mean, this is, all things given, that's a fairly accurate assessment. And then all we need to do now is, I mentioned we're using the capital asset pricing model, or CAPM. The formula for that is we take the risk-free rate, we add that to the beta, which is C69, times the market risk premium. And there we go, expected return about 14%. So what do you do with that information? Taking historical data and calculating future returns from historical data is errant in and of itself. But when forecasting the future, historical data is relevant, although you wouldn't want to just use historical data to do so. So there are a number of things we can do, building out covariance matrix, defining efficient frontier, looking at, if I have a portfolio of the S&P 500 and Nvidia together, what's the perfect blend of the two, or weighting of the two, to give me the highest expected return with the lowest amount of volatility or the lowest sigma. So in this case, this is the beginning of maybe a number of charts or analyses that you might want to go through, but it's a good start, and it gives you an idea of, if invested in Nvidia, what you could possibly expect future returns to look like. Hope you enjoy.